Good morning, everybody. Welcome to the Flow Show. A busy morning already, lots of data coming out, so lots to get through. Hope you're doing well. Morning, Kay, you all right, mate?
Morning, Ryan. Morning, everybody. Yeah, we're doing good, man. Ready for the last day of the month.
Yeah, all good fun. Lots to get through. Right, let's get straight into it then. I'm going to kick off with some data first and foremost. Where are we? Oh, I've lost a day already. Oh, where are we? Wednesday, that's where we wanted. Yes. Right, so in Asia, in China in particular, we had PMIs out from those guys, manufacturing and services PMIs, a little bit of an improvement, a bit closer to the expansion line, but still a negative, 49.7 versus 49.4 expected and 49.3 prior. Maybe this is a dead cat bounce or signs that we're turning the corner over there. Services pulled back a bit, missed expectations to the downside by a pip, so things still softening there, but the market has largely taken that a bit of a positive slant to those numbers there. Coming over to Japan, retail sales in Japan looking a little bit retail sales in Japan looking much better than expected, up 2.1% versus 0.8 expected. If I can find them on the list here, where's the retail sales? Can't see them anyway. Were they last night? Nope, don't know where the retail sales are, but luckily I noted them down. Oh, there they are. Year on year, 6.8%, also an improvement. But as I said, month on month, up 2.1 versus 0.8 expected, and minus 0.6 prior, as you see, strong on the reading. What wasn't good was industrial production, which fell 2% month on month, was expected to fall 1.4, so a bit worse than expected there. Year on year number, also coming in at minus 2.5 versus minus 1.4 expected for that as well. So got a bit of good data, got a bit of bad data, a little bit mixed over there. Now, what Japan is looking to do is to consider financial support for fisheries, which is said to be worth in the tens of billions of yen. That's according to the Nikkei, and part of this fallout from the Fukushima water release, which has been blown out of all proportion, in my opinion, because according to the actual details of it, it's clean enough to drink and contains no more radiation than sitting on a flight for 5 hours or something like that. But this has become a big political football, particularly in China and other Asian countries as well that get imports from Japan. So they're looking to maybe prop up the fishing industry there with more dough. Kishida is also looking at raising the national minimum wage to 1,500 yen per hour by the mid-2030s. The current minimum wage is around 1,000 yen, depending on what prefecture you're in. Some are a little bit lower, some a little bit higher, but generally it's around 1,000. So they want to up it by 500 yen over the next 6 and a bit years. So typical Japanese long-term thinking there. Now, interesting that we've had a BOJ member popping up last night, and some of his comments are pretty much knocking back what we heard from the BOJ man yesterday. We had Tamura out talking relatively hawkish for them. Nakamura's gone the other way. Says must continue patiently easing for the time being. That's a copy line there. But he says there's uncertainty on achieving the price goal. Says more time is needed before turning to tightening. July's policy decision wasn't part of any exit from ultra loose policy. Says he wasn't against making YCC flexible, but his opposition was about the timing of it. And an economic recovery is required for the BOJ to consider ending the negative rate policy. Personally, he doesn't see the need to stick to a January-March period in judging whether the economy is ready for a BOJ policy tweak. So again, that sort of counters what Tamura said yesterday as well. What do you make of all this Japanese stuff? Was it?
Sounds like
a bit of. Is that showing a bit of division in the BOJ? You know, one comes out and talks a bit hawkish, and another wants to come out and go against that.
Or a bit of a finger slap. I don't know. Well, I mean, it can't really be a finger slap because Tamura is he not one of the deputies? And I don't recall, to be honest. Yeah, but that's, you know, a lot of them are just following the leader, right? So this Tamura guy is probably been put there to have a little bit of a different voice, trying to help for the normalization, perhaps. But then it's still a tough ask over there to force them to normalize fast, you know. I mean, all of this, what we hear, and even Tamura yesterday was saying that he's going to be watching the January March data, so that pushes back against any early expectations that the market may have for the Japanese central bank to hike. Well, hike is even a big word, but to perhaps even just officialize the 1% target or top end or whatever, but letting it go. I don't make too much out of it, apart from what we already said many times. It's going to be such a slow process over there.
Yeah, very much so. But they are stepping up the support as well further, you know, up in the minimum wage thing. But that's going to be a slow burner, isn't it? But that's still fairly big for them. They're effectively upping it 50% over the next, you know, 5 and a bit, 6 years or whatever. So the ball is still rolling, isn't it, on, you know, changing the deflationary mindset over there?
Oh, very much so. Very much so. And is it Nakamura who said that the actual real rate is only around 1.3 or 1.4 or so? Was it him? So I mean, they seem to actually fight back against expectations that it may run hotter than what they think. Okay, and also we cannot forget, like you said rightfully already a couple of times, that China is not the rest of the world. Japan is not the rest of the majors either, right? They are going to do things differently, completely differently. Yes, it can create shocks. If you talk about the currency, for instance, if they normalize only a little bit, it can drive more bond buyers back home instead of elsewhere, and that should create some flows. But I mean, if you bank on it to say that, okay, the yen is going materially strengthen because the Bank of Japan is going to normalize, I think that's something that is not the right argument to have right now, because it's not going to go at any kind of speed that we could see elsewhere.
Yeah, very much so. Right, moving on and over to the BOE. And BOE's Peel says the UK faces second round inflation effects in particular. But on rates says there is the possibility of doing too much to fight inflation. A little bit of a dovish comment there. Then he counters that by saying inflation remains too high in the UK. There are cases for caution on inflation despite the fall in the headline rate. Says there is a danger some of the inflationary dynamics become embedded in the UK. I think it's too late for that. That's already happening and well entrenched. And he goes a bit dovish again to say one option for policy is to hold rates steady for longer, and he tends to favour that approach. So maybe a little indication that he may not be so keen to vote for another hike. They will have to see. It's about holding rates steady for longer. So get them up and then hold them there. We shall see. Over to the ECB. Actually, we'll look at the data first. Because it's CPI day in the Eurozone. First of all, we'll start with some crappy German retail sales. No let up over there for those guys in seeing poor data, down 0.8% on the month versus up 0.3 expected. Year on year, also down further. Switzerland, you can just see under there, also not looking good on the retail front. French consumer spending was up 0.3% as expected. But here we go with the CPI numbers in France. CPI up 5 pips to 4.8%, beating expectations. The Eurozone measure up 6 pips to 5.7%. Final GDP numbers in there unchanged. PPI, though, was down on the month, down 0.2%, but not as much as expected. It was expected a full 3.3%. So where we've been seeing all these negative PPI numbers, they're going to start slowly, or have been slowly feeding through into inflation. Things aren't falling as quickly as they were. You remember also Spain inflation went up earlier this week as well. On the unemployment, change in employment was up 18k in Germany. The unemployment rate ticked up to 5.7% as expected. So not going the right way for those guys. Italy as well, higher unemployment rate, 7.6%. Further into the Eurozone, even Portugal seeing higher inflation now, 3.7%. Italy was about the only one that it went the other way. CPI coming in down from the 5.9 prior to 5.5, but stickier than expected. HICP went worse than expected, and a decent drop, 8 pips. So you can see it's not all going the same way for inflation, but sticky is still the key word. Then we got the pan-Eurozone numbers. CPI, as you can see, was expected at 5.1, but that 5.3 unchanged over last month is probably the truer number given what we've seen from all the prior numbers, Germany, Spain, France, etc. So not really a surprise that it was higher than expected. The core number dropped 2 pips as expected, maybe seeing some easing there. I think that's probably the only bright spot for the ECB out of all the numbers we've seen today, that the core has come down 2 pips, but it's coming down slowly and still very sticky. So over to the ECB BODs, ECB Centeno, Big Dove, said Eurozone economic growth indicators have been surprising on the downside recently. Downside risks for growth outlined in June predictions are materialising. Is firmly convinced that inflation will fall under 3% by the end of the year, but we need to be very cautious about policy decisions, as a lot has been done already. Even if there is a pause, saying that we are done would be the wrong message. ECB Schnabel says we cannot predict where the peak rate is going to be or for how long rates will have to be held at restrictive levels. ECB's Hawke Holtzman, speaking after the inflation data, said the data is a conundrum for the ECB. We are not yet at the highest level for rates, and another hike or 2 is possible. Now, after all that, money markets have been a bit all over the shop in pricing the ECB this week. It was at 40% earlier this week, then it jumped to 50%, then it fell back 5 minutes later to 40%. Now it's down to 30% chance of a 25 pip hike in September. That's down from the 40% early in the session. The rate probabilities are about the same, pricing a 29% chance of a 25 pip hike in September. Now we've got a bit, before I go into some of the other stuff, we've got a bit of a discussion in our chat room about what's going on in the euro, because I personally would have thought the euro would have been a bit higher after all those inflation numbers, signalling the stickiness, but it's been sold off. So there's 2 trains of thought here. One, that the market's trading the growth story rather than the inflation story. That's your line of thinking, isn't it, Kay? Hence why we're seeing the euro lower.
Yeah, exactly. I mean, it's not that inflation, the importance of inflation is going to be pushed back, because we know that the ECB, their main, well, it is said that their only mandate is inflation, but it's price stability, and it's not clear in the rules where or how they really define price stability. So a lot of members are saying that it is just inflation. Holtzman has been repeating it no later than a few minutes ago. But then if you look at all the other comments, they do comment about the risks to the economic outlook. So and for me, and I've been saying that I think already a few weeks ago, and then probably tend to be early with calls like that. But to me, the inflation story is not going to be pushed completely into the background, because that is going to be a driver for whether they keep rates higher for longer or not. But the growth story is going to put a spanner in the works, because the data in Europe, in the Eurozone, have been gradually getting worse. The ex-inflation data have been gradually getting worse. And I think that is what ultimately may weigh on it. Now, the issue that I still have in these markets is that, and I've sold a bit of euro, and as people know, I'm managing it relatively quickly, because I still can't find one block that is not at risk of weaker economic data, and especially not the US. So it's a bit tough to have longer term views for now. Hopefully tomorrow there's another piece of the puzzle which will be fitted in. But I think based on what's going on, and historically, if we go back to the even 30 years ago, and 20 years ago, and we have seen it with the yen as well. It's not because your inflation is high or low that your currency is going to follow blindly what inflation does. We have seen historically exactly the opposite happen. And at one stage, your currency is going to be more impacted by growth and by the story of safe havens and things like that. If you look at the Deutsche Mark, for instance, back in the 80s, 90s, had ultra low inflation, ultra low interest rates, yet everybody was buying it because it was the growth story and the solid behavior of the German economy. I mean, today we could argue we are in a not completely opposite scenario, but we are in a scenario where the ex-inflation data are not great in the Eurozone, and that's where my argument goes, that if you look back historically, it's not because you have high inflation and even higher interest rates that your currency is necessarily going to strengthen. And I reckon the further we go down the line, the further we see perhaps inflation coming down, because I think in Europe it's if the consumer doesn't follow, if the manufacturing is low, sooner or later that's going to weigh on your inflation as well. Once those base effects or whatever are out of it, it could actually then inflation turned over again. So inflation went before everything else. Now we are in this phase of where I think we can, or we are in a zone, a possible zone of inflection, where the real economic data, as I call them, or the street economy, is going to take over from the inflation data. So that's where I think what we are going to see, and what we are currently, especially today, for instance, but we have seen it already a couple of times before, where other data are going to impact the strength or weakness of currencies as well.
Yeah.
And again, I don't think we can already take a long-term view on it, but at least in the short term, I do think, and we find it back today in the euro process, where we can see the currency weaken despite sticky inflation. That is really my point, right?
Yeah, and I agree with all that. You know, it may not be an ECB's mandate about growth, but it's obviously something they're going to look at. When I say I'm surprised euro isn't higher, I'm not saying euro should be trading at 110 or anything like that. I'm more surprised that it's dropped. But every move tells a story, and this answers Ali's question that he's asked. If all the data's going down, what if all economies are in trouble, what do you buy then? And that's a good point. I think what I'm looking for, particularly at the euro right now, is if the market gets too dovish, if it's trading the growth story more than the inflation story, it means it could get too dovish on the ECB, like predicting cuts, which is what we're going to be playing, as I've mentioned several times, towards the end of this year and into next year. So for me, it's about judging the central banks. It's playing who moves more. So if I see moves going too extreme, if growth is faltering but inflation's still going up, the ECB are more going to be worried about inflation than they are growth, compared to the Fed, who are in the same situation, will more likely act on growth. So that's where you're going to get your divergences popping up. So if the market thinks growth is bad in the Eurozone, we're going to sell the euro to extremes, but inflation's still going up, then the ECB aren't going to turn dovish. They may not hike, but they're not going to cut as quickly as maybe another central bank will do. And that's where I'll look for disparities in the market and versus the central bank. So, in context, the euro going down 30, 40 pips a day isn't a big deal. We're still in the same old ranges and whatever. But if we start busting those ranges on the market getting too extreme, that's when I look for an opportunity or potential opportunity. And this is what we're going to be playing, as I say, into the end of this year, into next year. What is the market going to do versus the central banks, and what is each central bank going to do depending on the data. So in terms of what you want to buy, Ali, you've just got to try and nip in and out between the opportunities. And as Kay says, it's hard to look at a long-term trend. You can't go bang, the US is going to suffer more than anyone else, so you're going to sell dollars, because it's also a weighted game, not in terms of weighting in terms of time, but in terms of heaviness. If you trade in the US against the UK, what goes on in the US is going to outweigh what goes on in the UK. Same way if you're going to trade Eurozone to the UK. The Eurozone's a much bigger block. What happens over there is going to overshadow what happens in the UK per se. So all these divergences are going to be popping up. They may last a day, they may last a week. And as I say, what I'm going to be looking for is if some of those moves get a bit extreme, I'll try and counter that in trading wise. But as what Kay says, yeah, if it's a growth story we're trading, that's what the market wants to do. Fair enough. I'm not going to stop it. But if it goes extreme, that's when I get interested.
Yeah, but I mean, the thing is, as I also said, I mean, it's very difficult to get the longer term view in play now, because it's a lot of moving pieces. But if you talk about central bank divergence, I reckon the ECB could actually stay higher for a little bit longer, but then higher for longer. Then you look at the interest rate differentials, and I'm just picking up on what is it Chris Northheimer or Charles, because I don't see the name here, says about the differentials. I'm looking at the differentials very much. As if you follow us here, I nearly daily show the EU-US differentials, because I think it's a big driver for the euro dollar. So you do trade interest rate differentials because it's still what the market really trades, right? For the time being. But beyond those differentials, there's going to be times where the growth story takes over, or the data. Well, it's mainly a growth story, right? So yeah, I do look at that, and there I'd argue that even if the ECB stays at 4.25%, but the Fed stays at 5.25%, 5.5%, you still will have a small, albeit differential between the US and the EU. And don't forget that countries like Aussie, Kiwiland, and Canada is around the ECB, and there's not that many big differences between the majors. And then I think it's even more important to look at growth. But that was like trying to answer two things at once. So yeah, I do look at the 2-year differentials. Or are you talking about the curve? That was the question. Okay, moving on.
Yeah, it's a fair point, because you've got to remember, we talk about, a currency may get sold on growth worries, but also if rates are staying high, there's also a yield play to be had as well. So if the ECB's at 4%, growth slowing, the UK's at 5.75, let's say, and growth slowing, traders are going to go into 5.75 and lock in rates up there, because they'll get a better return. And also, obviously, if rates start dropping, then they're locked in at high yield, so that can attract flows as well. It's just the way money works. You can sell it on economics and you can buy it on returns. So there's always a different storage happening in FX, which makes it why it makes it so interesting to trade. But anyway, as I said, moving on. Just going back to the data, and yesterday's ADP came in a little softer than expected. 177k versus 195k. The prior was revised up quite decently to 371,000. Overall, I would say that's still good enough number. We're not seeing any outright collapse in the numbers there, so it may be softer, it may show a slowing trend, but nothing that should change anything really for the non-farm payrolls tomorrow, which is also expected to come in around 170k. I think. Let me just have a quick check to see if it's changed or not. 2 seconds. Yeah, 170k we're still expecting from the NFP, so that hasn't been revised much at all. GDP for the US was also revised down to 2.1%, so a slightly lower revision there, but some of the other components underneath it were okay. Consumer spending was up okay. Sales was decent enough, tiny miss. Corporate profits you might call that a surprise, up 1.6%, was expected to fall 5.9%, but given all the earnings numbers we've seen for Q2 over the last few weeks, that's not so much of a surprise to see that profits are up over there. But overall, it's a little bit softer, but that was the original 2.4% flash was a bit of a surprise in the first place. So it shouldn't be too much of a surprise to see it a bit lower. Still trending well enough, in my opinion, for soft landings. Right, over to Mexico. And Central Bank Governor Rodriguez said they're going to hold the rate until disinflation consolidates. Back to the US and more wage talk. Apparently, Biden is looking at overtime pay and extending it to millions of workers. This mainly related to the sort of restaurant and hospitality leisure sector, which, as we know from prior ADP reports, has been one of the biggest drivers of those numbers. Pretty much the bulk of those numbers over the recent months that we've seen ADP have come in the hospitality sector. So that's potentially an inflationary input there if he does extend those wages. But on the other side, it could also be a little bit of a boost for the consumer and spark a bit of retail sales action going on there if there's more money in the pocket. Strikes over in the US as well. American airline flight attendants are going to vote to authorize a strike. There's some 26,000 of those. They want better contracts. The US is seeing a lot of strike action over there over wages, so that is also something that the Fed will keep an eye on in terms of wage price spirals that they want to see kicking in. And Russian Foreign Ministry said that the Black Sea grain deal will be on the agenda when Lavrov meets his Turkish counterpart. Turkey was instrumental in organising the original grain deal. We know this grain deal was just cover for being able to play warships in that area and stopping boats coming through. It's led to all sorts of attacks, as we know, going on over there. So if we do get something that softens that, that'll be good for commodity prices to come back down, and which is also another inflationary pressure that's coming into the mix. Right, that's it from me. Kay, you got any other headlines you want to bring to our attention?
No, just one where the death of one is the how do you call it, the opportunity for the other.
If one door closes, another one opens.
Yeah, if you see the quarterly revenues of UBS coming out, it's actually a joke, right? I mean, They made $29 billion gain just because the Swiss government sponsored their takeover of Credit Suisse. I mean, it's an absolute joke. I just wanted to throw that here. It's crazy. It's crazy. Oh, did you talk about the Norwegian kroner at all or not?
No, I didn't know.
All right. So the Norges Bank, as is traditionally the case, they come up with their monthly FX plans in Norway, and they actually added 100 million Norway, which is really not a lot, but it's per day, to their daily sales of Norwegian kroner buying FX. So instead of selling $1 billion Norwegian kroner per day, sorry, they are going to sell 1.1 billion Norwegian kroner per day. And as we can see, the Norwegian kroner didn't like that at all. There were some voices that they could strategically cut their NOK sales because of the relative weakness of the Norwegian kroner, and pause it a little bit or reduce it. But actually, no, they actually increased it a little bit. So the Norwegian kroner got a bit of a slap this morning on the back of it. So they are not helping their own currency at all. Just for, I know that some people in the room like to trade scandies. This is, I'd say, important enough to note not the size, but the actual size of the increase, but the fact that it is an increase actually in selling Norwegian kroner. So that's worth noting this morning.
Yep, thank you very much, mate. Right, well, let's get stuck into some prices. Let's go back to euro dollar, because although we've got this bit of a sell-off, we really still walk in the same old places. I mean, I've been mentioning the 109.40 area as the possible resistance point. It's one of those on-off. It's not exact on the number, as you can see from prior tests. You know, we poke above, we poke below, and that sort of thing. But it seems to be a bit of a pivot area. If you get above and hold it, then you move somewhere else. And it's held a couple of times, got up to sort of 45s yesterday, then another little nudge overnight, and now we're back down again. So, you know, we've had similar moves in a lot of pairs. They bounced pretty strongly off of lows, but then as soon as they hit a decent enough area, it's enough of a brick wall to keep the price from passing by. So for this one, you know, it's just going to swing around with the data. We get some hot PCE data later on. You know, this one heads lower, maybe back down to the lows again, and we see what we want to do with this trend line once again. So again, it's difficult, really difficult to take a side. You know, you pick your levels. If you lent against this 109.40s, good stuff. You're in the money. You got something to play with. Make sure you take some money off the table going into the data points, because if it doesn't go your way, you're back there in a flash. And the same thing going on a pair like the Kiwi, which, you know, been waiting forever for this one to bust up through 59.90 and the 60 big figure, poked its nose, didn't like what it saw, and it's back down again. And as I've been mentioning, you know, I don't think these lows are quite, we're done with these lows quite yet. So these pairs are not looking, some of these pairs are not looking to go anywhere significant. And as soon as they hit something more solid, you know, these are still small areas in some terms, you know, all these levels in between. Then you hit a big level, you know, up at, as I say, that 60 handle, which was a prior support point, very good support point. You know, you can see why it runs into trouble. So if you're buying pairs like this, if you're not getting the breaks you want, you've got to look to get out, take some money off the table and protect what you've got in case you get a steeper pullback here. But overall, nothing going on. We're bang in the middle of this sort of recent range. So we just need to go for the data. I would potentially consider adding back to my longs, because this pattern is still playing out. We're not really breaking lower. The only thing I'm cautious about here is that we have been making lower lows and following this trend line down, which isn't good. I'd like to see a bit more solidness or solidity, however you want to call it, around the 59 level. But got this potential, you know, 58, 85, 87 area here as the next support point. So that's the next watch point if we do head back lower. It's been the same for Aussie dollar. had a little poke up above 65, didn't like it, got up to 65.20, hit the zone, an old traffic zone, and down we've come again. It's really been the story in a lot of pairs at the moment. And you've, as I say, just to repeat, you've got to be careful. If you're running these trades, if you're on the right side, if you get yourself running into a brick wall, take some money off the table, or look to take some money off the table, maybe bring your stops up, just protect it in case you head all the way back down again. Dollar China, another one still not doing an awful lot, as you can see from that 4-hourly chart, still mooching along. Kay, do you think they're keeping this one contained for the moment?
Oh, definitely. I mean, they're just and the market is actually, I think definitely yes, they are just keeping it there. We heard a little while ago that the Chinese submarines were selling a bit of dollar China again, but then if you look at the first time they did it, dollar China went down 4 big figures, then it went down 2 big figures, now it went down 30 points. I think they're just trying to stabilize the whole thing, and then hope for the investors to give up. But in the meantime, and Boubacar was just commenting on Country Guard, and I think Boubacar, I mean, we know about all the crap happening over there, but it's a much even more than Swiss franc managed currency and economy. So and we have seen on those slightly better PMIs out of China that it barely moved. It's just I think we need to keep the global idea about what's happening over there, which is for the time being not good, and then you look at what your price action is doing, and you just go from there. I wouldn't. We know it's crap over there with all the developers, but perhaps if there's light at one stage, if there would be light at the end of the tunnel, which is like the consumer starting to get back into the market, or work conditions and stuff, not the conditions, but the labor market also doing a bit better. They're also wrestling with climate catastrophes over there, a lot of floodings and stuff. But as soon as that is going to turn around, then probably dollar China is going to turn around. If in turn it's not improving very soon, the investors will likely just remain on with their idea that China for the time being is as what was her name, Gina Raimondo said, uninvestable. You know, it's just a part of the bigger picture. I don't know whether that changes anything right now. So I'd say really watch what's going to happen, and then in a second instance, watch what's happening with the dollar. Because tomorrow has, or PCE, I think in a way could influence things a little bit. But I think tomorrow, as we've been talking so much about the jobs market being, or the labor market being one of the last big dominoes standing, that if we see a change there, that could influence all the dollar pairs, full stop. So we've got to watch really both ends of that coin, but I don't think that any more trouble with Country Guard and with Evergrande or whatever is going to make the market get more nervous or more confident than it is right now. That I don't think so.
Yeah, no, I agree with that. I said it even when the Evergrande stuff first popped up. It's not going to lead, you know, you had your zero hedges saying it's going to lead to a global meltdown and whatever. But this is China. They're not going to let something like that happen. And this is just yet other news. Don't get me wrong, it adds to the negative slant that we're seeing on China and the negative sentiment in China overall. But in terms of real reaction and what it might cause, I don't think it's a big deal at all. Until it happens, I don't think it will happen. But until it happens, or we do get a big knock-on blowout, it's all going to be contained, and then you just got to roll with the punches as the market wants to take each headline as it comes. No, Brian, that was the Ever Given ship, nothing to do with Evergrande, the property company. Though I think it's all ever this and ever that. They're probably all tied up to each other anyway. Right, Mr. Anonymous attendee in the Q&A says, do you think that the market is right to price a hold in the September meeting for the ECB?
It's a limit border. It's like really a dime on its side, right?
Yeah, I think it is a bit 50-50. Certainly the inflation data suggests they'll hike again, but even the market pricing or expecting a hold in September, they've still got raised expectations for another hike, be it November, December, or whatever towards the end of the year. So it's a bit like one of those situations. Well, if they're going to hike, you know, why hold a month only to hike the next month, sort of thing. I think we've probably one and done for the ECB, maybe at very most two. But that would be, I think, a stretch for a lot of the doves on the ECB Council to go for two hikes. But, you know, we're data dependent. If inflation goes up for another 2 months, they're going to stay hawkish. So, yeah, market pricing is a bit funny, and it's been very funky this week, as we've seen from those money market pods, which is just the market moving around. You know, it went from 40% to 50%, then back to 40%, now to 30%. It's very jumpy, and if it tells you anything, it tells you the market's unsure. It doesn't know where and what it wants to do exactly, because if it did, then pricing for the various meetings would be pretty steady. So it's just, they're in the same boat as us. It's all guesswork at this stage, and unfortunately, we've just got to go with the data points and take it day by day. Really can't make much long-term plans around all this. Right, Kay, did you want to grab it for a couple of minutes?
Yeah, and I fully agree with that. While I'm taking the screen, it's really, and that's why. Ali, I know what you're saying, and you're right in trying to look at the longer term to avoid getting trapped into some stuff. That's completely right. The problem I have now, and I've been in long-term stuff, you know. I mean, for instance, Euromex. I've been short since I don't know when. I mean, virtually since the pandemic started to turn around just that slight bit. I've been short for a very long time. Long-term trade, but long-term trades in euro dollar right now, it's a big ask. And really, I've been in the markets for very long. Ryan has been in the market for very long. Other people in the FA community are being in the market for very long. But when we say we don't have a bias, this doesn't mean we don't trade. I mean, I'm a little short euro dollar because I think some stuff, but I'm also aware that tomorrow the NFP can throw the dollar completely off its pedestal, and that's why I'm saying, in this market of uncertainty, we don't know whether the central banks are going to hike more or not. We don't. Okay, we probably know that they will stay higher for longer, but that increases the volatility. It doesn't increases the chances of making new trends. That's the thing. Higher interest rates create much more volatility than low interest rates. Okay. And so you're going to increase volatility, but increased volatility should not be mixed with trends. I mean, trends is a different thing. If you and look at it, look at this here, and I'm going to go back on the daily. Look at the pandemic. I mean, and this is the 2-year differential US versus euro. Okay, this is 2018. When the US started to when we had some stuff here, and this is 2018, and then come here, you come here, and there you have the pandemic kicking in. You do this, and then look since then, up, down, up, down, up, down. Tell me where there's a trend in this. Okay, we could argue there's a little bit of a channel here, and where the euro is gradually getting back. I mean, tighter versus dollar, but that's just because ECB started to raise rates later, and then started to catch up, right? But is there a trend? I don't know. And same goes for the euro dollar. Is there a trend? I don't know. Not for now, at least. And if you look at the moves actually today, look at what happened since we had those data out and stuff. Despite some stickier inflation, this is sticky inflation, and what happened yesterday with the US rates, right? So the differential on the short term, this is twos. The differential on the short term went tighter, so the euro ran up, and then it lost steam, and we are back down, and the euro dollar is back down. So I just repeat what I'm saying every day. Look at this. This is one of the guides to what's happening in the euro dollar. Okay. For the rest, we are end of month, and with the last day of the month, yes, we have F.A.C.E out this afternoon. It could be a market mover, but I'm still going to say, like, we don't know what's going to happen until tomorrow. Okay, as I've said earlier in the week, I think we needed to take from the jolts and then all the European data as well, if you trade euro dollar, from the jolts, the European data up to tomorrow's NFP, and then you really make up your mind, right? Because we will be past end of month, and we will start the new month with the US labor report. That's important enough. You can trade it on its own, but I would say once that comes out, take a look at everything that came out this week, and then make up your mind if you want to trade something for the more medium term, more than the intraday, let's say for a week or so. So short term, back into the wedge in the euro dollar, and I think there is a possibility of trading this a bit lower. I don't know what the month-end flows will show us, but it's clear, and we can find it back on the euro crosses, that it's a little bit heavy here right now. Okay, so I'd say there is a possibility we're going back to 108.30s, and then I will probably be relatively flat and taking a little bit of this, and then wait for what the fixings will bring, and tomorrow the labor report in the US. Cable is pretty much the same, right? Although euro sterling is a little bit weaker with the euro moves, we are back around 126.80. Reminds me that 120, what was it? 125.5, and then before we had this other magnet here around 120, 123.5. Looks like
124.50, wasn't it? That funny level.
Yeah. That looks to be your new obliged stop on the tram line. This 126.80. I think it's important enough. I'm not looking to trade anything in sterling right now, but this one could be important enough tomorrow to know, are we above or below? Could be something. If we start in turn to have like yet another surprisingly good jobs report, which it shouldn't be if you look at other reports coming out, this could be a weaker one tomorrow. But if you start to go down, this is really your danger area right now. I think if we get down below those prior lows tomorrow, then it could really falter. I'm not going to look at too much right now, but just to let you have a view of what happened here in the Norwegian kroner. Look at this dollar NOK. So we had the low on the high on the euro dollar, which printed a low on the dollar NOK yesterday, and now with this Norges Bank, we are already on our way back to higher levels. Keep this little, if you want to trade Scandies, keep this little what is it, like triangle or whatever in mind for tomorrow, and keep those external boundaries as well in mind. 1077, 1050. Okay, this could be one that is going to be quite tradable after tomorrow. I'm going to keep a close eye on it as well. Dollar yen, I don't have much to say. Yes, we've broken this, but it's getting out sideways. I don't have much to say. The only thing I can say about the yen, as usual, is that the Bank of Japan is not going to normalize anytime soon, or no, anytime fast, and it's going to be a snail's pace. Now we need to look at what the other data are going to do. The data on the other side of the pair. For instance, the dollar tomorrow, but you can talk about any of those, any of the currencies against it. You talk about the euro, you talk about the sterling, the antipodians, for instance. They can be the movers. If the rest of the world does not fall apart, I don't think that this has too much room to go down. If the rest of the world starts to falter, this party could be over, and we start to go lower. Watch your US 10s tomorrow very, very, very closely. We are on support 408, 409, and then we are probably tomorrow going to trade around here somewhere. If it comes down, that's your 4% mark. If that goes below, then your dollar yen is toast, at least for a while. Okay, so if tomorrow the NFP surprises or even keeps a decent number, and we hold this and we're starting to go higher again, then I think your dollar yen is going to tackle the prior highs again. Okay, and I leave it to that for today.
Thank you very much, mate. I'll just finish off by echoing your comments on trading. You know, I'm a long-term trader by nature. And if I'm not getting long-term trends or something I want to get my teeth into, I've got to trade differently, and that's what everyone's got to do. But if you're taking every trade thinking you want to get 300-400 pips out of it, then that's not going to work. You just need to get in a trade at your levels, take some money off the table when it comes, and try and push it as far as it goes. And if it runs 300 pips, all well and good, but don't plan for it. Try to stay in the trade as long as possible, but you've got to be very flexible and very nimble right now, the way markets are. Anyway, that's that for today. Do have a good day. Watch that PCE data. It's expected to follow the CPI data as well. Year on year, PCE expected at 3.3 versus 3% prior, which is the same as CPI. Core expected to tick up a pip to 4.2. So that's going to be our market mover later on. Thank you, everyone, for coming to the show. Thank you to Kay for all his valuable insight as usual. And we shall see you. We won't see me because I'm off tomorrow, but you shall see the K-Meister tomorrow and covering everything for the NFP and whatnot. Have a great day, everybody.
Hey, and vote for the NFP, guys. You can win a what is it, a month, Ryan? For free?
Yeah, don't forget to enter the NFP competition. Keep an eye on the ForexAnalytix Twitter account or mine or Kay's as we retweet it. And you can come and join us in the room, and you can do this, what we do on the show, all day, every day in greater detail. And you have our ears in there as well.
Yeah, go to the Twitter handle, Ali, because we won't, we don't accept votes on here, okay?
Yeah, stick it in there.
Guys.
See you later.